Hello friends, in this video I'm going to help explain the difference between a traditional index fund and an exchange traded fund or an ETF, and hopefully that is going to help you with your decision making as you embark on your investing journey. Now, if you're new to the channel, my name is Charlie and I'm an investor based here in the UK. And on the Kowalah School channel, we're helping young and first-time investors to embark on their investing journey safely and successfully. Now, one of the most important things that you must always keep in mind when you are investing is to only invest in things that you understand and could explain to someone else. And therefore, if you don't know the difference between an ETF and an index or a traditional index fund, then this is going to be an important video for you. So firstly, let's just explain a little bit about what both of these items are. They're both funds. And a fund, as you may know, is a way of investing in a large number of companies all in one go. An index fund automatically tracks an index like the S&P 500 or the FTSE 100. And it means that for you and me, it's really, really simple. Someone else does all of the hard work of picking what stocks to invest in. And because of that, it can be low cost because we're just tracking an index. But so what's the difference between an exchange traded fund and a traditional index fund? Well, let's take a look on my screen at an example. So what we can see here is a traditional index fund, the Vanguard US 500 stock index. It is automatically tracking the S&P 500. And let's take a look down here at what that is made up of. So here are the top 10 holdings. We've got some familiar favorites: Apple, Microsoft, Amazon. And take a look at this percentage, because we'll have a look at this in a moment. 6.73% for Apple. That is in this traditional index fund. Now over here, we've got a very similarly named product, also from Vanguard, also focused on the S&P 500, but here we have those three letters, ETF, meaning that this is an exchange traded fund that you can buy on the stock market throughout the day. Now, let's take a look at what makes this up. And here we go. We've got some similarities: Apple, Microsoft, Amazon, Facebook. And remember that 6.73%. And the eagle-eyed, you'll know that all of these were exactly the same percentage as well. So both the traditional index fund and the ETF are giving you access to exactly the same companies in exactly the same proportion. So if they're exactly the same, how do we make our decision? What should be important to us? Well, as with all of these things, it comes down to fees and what is going to be the lowest cost way of accessing these types of products. So firstly, let's take a look at the costs for the traditional index fund. Now, these are being held within Hargreaves Lansdown ISA, and the ISA itself carries a management fee of 0.45%, up to £45 per annum. And so over a 5-year term, if you'd invested £5,000, you'd expect to spend £125.58 on your Hargreaves Lansdown management fees. And then for Vanguard, they're charging 0.1% and a few transaction costs as you go through. Summing all of that up, over 5 years, you'd expect to spend £157.27, or 0.56% of your investments. Now let's take a look at exactly the same thing for the ETF. Once again, we've got a 0.45% for holding it within an ISA. But then, because we are buying a share, which an ETF is, traded on the stock exchange, for Hargreaves Lansdown, this could be $11.95 when we buy the ETF, and it could be $11.95 when we sell the ETF. And then on top of that, we've got the fees from Vanguard. These are slightly lower at 0.07% for the ETF compared to 0.1% for the traditional index fund. All in all, that's totaling up to £172.85, or 0.62%. So that's about £14 more over the 5 years than you would have had for the traditional index fund. So it's there or thereabouts, but it's worth paying attention to. Now, Hargreaves Lansdown is probably on the pricier side when it comes to buying and selling shares. If you invested through Interactive Investor, then they provide you with one free trade of a share or fund each month. And after that, you'd be spending potentially $7.99 for each trade. Or if you set up regular investing with Interactive Investor, then you pay nothing for funds or shares. So the ETF or the index fund would be equally low cost for you to invest in. Similarly, if you are over 18 and you're investing on a trading app like Trading 212 or Free Trade, then, for example, with Trading 212, they really are focused on low costs. So there's zero administration charge for the year, zero commission whether you're for that ETF, and zero for any dividend reinvestments. But you should bear in mind that Trading 212 or Free Trade do not provide any access into a traditional index fund. There are then a few other items that you might think is a differentiation. So one comes up a few times, which is around capital gains tax. Both a traditional index fund and an ETF can incur capital gains tax. An ETF is a little bit more efficient when it comes to capital gains taxes. But the point is that you should be investing either through a junior ISA or an ISA, in which case there are no capital gains tax on any of your investments. So that shouldn't sway your decision either. The second one might be around trading times, when you're available to trade. A traditional index fund is only traded once per day. So even though you might make your request for a trade at breakfast time, at lunchtime, at evening time, that will only be priced and executed once per day. Whereas an exchange traded fund, just like it sounds, you can invest at any point during the day and you'll get a real-time price. But because we're doing regular investing and we're holding over the long term, we really shouldn't be worried too much about whether we're investing at 1 p.m. or 1:30 p.m. and how much things are going to fluctuate on the S&P 500. And the third main difference that you might think about is that an ETF, because it is traded like a share, some products will give you access to things like shorting or options and some of these more advanced features where you can trade with money that you don't have. Now, absolutely, that is something that we do not recommend, certainly not for an amateur or first-time investor. And therefore, although an ETF gives you access to these things, it's not something that should sway your decision because you shouldn't really worry about it. So ultimately, when it comes down to a traditional index fund or an exchange-traded fund and which is the best model for you, really focus on the costs. If you can get it for zero commission, then pick the one that is going to be the lowest cost for you. So I hope that video has been useful for you. If so, please share with your friends and click to subscribe to the channel because we've got loads of great new content coming over the next couple of weeks as we try and help you to embark on your investing journey safely and successfully. Thank you very much and happy investing.